Okay, Sunday, December 18, 2016. I'm going to start off with Priceline here. I believe I posted either Priceline or another online travel earlier in the week at StockTwits. Basically, at a gap, couldn't hold it, and now it's reversing. In my eyes, something fierce. Okay. You can, on up above here, I just have a 14-day RSI. It's a daily chart. I clipped above it. How RSI works is when it goes up, if you use just a traditional like 14 period here, so 14 days. I use 10. The trigger's a little bit early. It's just to have me then drop it down to like a 2-hour chart, that kind of thing. It's just because it goes into 70 doesn't mean that the trend is reversing. It's when it comes back through. Okay, so and for it to hold like here at the 50 line, okay, if it holds at the 50 line, it's a continuation. Okay, now RSI is an interesting indicator. Another one of Wilder's indicators. Basically, it tells you, if you go 2 steps forward and 1 step back, that's +1. And if you go 2 steps forward again and 1 step back, that's +1. So +1 + 1 is +2. So that's how that goes. Okay. Basically, a lot of what I want to do is to have you guys hold stuff longer than the afternoon. But if you are a day trader, bless you. You go home flat. You can sleep at night. You don't have to worry. But the deal here is, like on the commodity side of things, on the future side, you get 4 good trades a year. Okay, so for 2016, most of them have been on the long side. Okay, where you had all of them move. I view that though as more of a wave 4. Then we'll actually find the lows during the next recession. Okay, but I would just wanted to start off with that as I go over equities. Now, this is how I'm going to start. Okay, so I have a CBOE options total put call, okay, ratio. All right, so this is the amount of call buying versus put buying, okay, and I sent this out, I believe, last week also, that we had a frothy move of call buying, okay, so this was after the move, okay, so the call buying came in after the move that we traded higher, okay, so the call buying, I look at it more than just weeklies. I'll look at it as years ago, before we had weeklies, you used to have to go quarterly, and then you could get monthly on the series rotation. Okay. Now going back to sometimes when we had call buying that says 60, here's 62. The 62 basically we went sideways. Okay, I'm just using the S&P. Okay. Here was another one where they had 60. We basically traded sideways. This, of course, is 50 points, 50 points, 50 points. So even though it looks like we went sideways, we still dropped from, we lost 100 points in here going into Brexit. Okay. Back here's 57, and this is prior to the Chinese devaluation. Okay. Where they have frothy call buying, and then the market falls apart. And here, I believe it dropped 300 points, the S&Ps. Okay, and on the flip side, then you have put buying. This was the gap and go video before the election that the put buying was too extreme, okay, and we basically ran the other direction, okay. So I'm not saying that the market's going to roll over, but there's a possibility of it going at least sideways. And but how I'm kind of leaning though, the Dow futures, NASDAQ futures, and the Russell futures, the bodies are in there with money flow, but they're lacking in the S&P, okay. What I think is happening is that people in the S&P future side are holding back, okay, to see how earnings work out for January. Okay, that's what I think is happening there. It is a tad bit frothy in the small caps, the Russell, but remember that at the end of the move from 98 to 2000, it was smaller caps and IPOs, and it feeds on itself. Right now, the Federal Reserve basically is taking away the free money where companies can go and issue debt repurchase their shares, because a lot of these CEOs are paid on how their stock performs. Okay, so it was beneficial for them to issue debt. Okay, and to buy back the shares to move the price higher. That's what a lot of this move was. We had a lot of buybacks. It decreases the amount of shares out there, right? So you have a shortage. Okay, now the Federal Reserve removed the free money. So companies have to actually do what they need to do. This is where they have to buckle down and actually make it work. The US dollar, okay, we got to 103. The next target would be 105, but it's moved at a pretty good clip. We're at a 14-year high. So what that means is the repatriation of dollars, unless they're hedged, they're losing money on it. So as the dollar increases, it makes the exports more expensive, which means that they have to drop the price. And when they do that, then they also have the running of repatriation. So if the dollar goes from 103 to 105, it's hurting them. It'll eventually cause issues where we have difficulty exporting. That's why I have a tough time believing that we're going to onshore jobs again. We're 84% service. The people who used to work in factories, who didn't mind sitting there 8 or 12 hours a day in their own brain, are forced to have to go out and deal with the public, and that doesn't work. And so a lot of people go on to disability. In our country, the United States, we're at that cycle of the empire that we become a welfare state. Automation is an issue. It's like groceries. I go to the grocery store, I'll use the machine. One thing of interest is I was standing in Bank of America this week, and an older gentleman claimed that he doesn't use the ATM, and I went up there and told the 20-something that he's helping you to save your job. But the lady behind me told me that she said we're not supposed to trust the ATMs. So I thought that was interesting, kind of like the reverse fake news on Facebook, which is fine. The automation, it takes jobs, and the whole thing on the whole economy is you give somebody a paycheck, they spend it all, they buy the widgets that they manufacture, and that's how that works. But on here, I'm leaning that at best, okay, at best at the market, for on the S&P will be stagnant. But on my last video, my opinion video, I talked about the first drop from Richard Nixon. Okay, now that one ended up being a little under 12%, like 11 3/4. Okay, that would actually put the S&P futures back to the low of the night of the election, when we dropped 700 points overnight. Okay, so basically, if we lose the 2243 area, I would have to look that we would go back to retesting that low. There are places that would probably pause. Okay, so that's why when I look at things, I try to, I don't know where you guys are at. Okay, I know you want to go after options because it's the Grand Slam thing. Okay, but if you go in a week and this lasts months, you're in trouble, because the volatility will increase and you'll have to pay up. Okay, I'm a big fan of selling options against positions. I talked about that last week. I mentioned, say if you own Coca-Cola, and I said about 15% out of the money. Let's get back to reality here. If Coca-Cola goes up 15% in the next quarter, right? In theory, you would lose your stock because you wrote the call option. It would be called away from you. Okay, but let's just put this in perspective here about how much the market does per year. There's been a lot of giddiness. A lot of these things have basically gone bonkers. All right, that's what happens at the tail end of things. In December of 2005. The economy peaked. with the real estate. We ended up building 7 years worth of homes in 1 year. Okay. And that was speculation. You could buy it with no money. Down was the teaser. That's how we essentially made the real estate market blow up. Okay. I read a story about a Russian immigrant who bought 10 homes in Las Vegas with $1,000 down each. Okay. And then of course the builder had a few dozen left over and he dropped the price 20 grand. Well, this guy's out 200,000, right? And they caught fire 3 times. All right. So what I'm leaning is first off, we have frothy call buying at the high. So at best it's sideways. If S&P futures lose the 43 area, if I go back to the Nixon thing, it dropped about 12%. Okay. That would take us back to the low. All right, I have 3 sets of, there's the total call buying ratio here, okay. This one here is the equity, so this is individual issues. So I circled down here that we had frothy call buying. Back here in June of 2015, we basically had frothy call buying and went sideways. And then a few months later, China came through and the market fell apart. That was another buy situation. That was I call it shopping carts. My posts will get lost in the flurry of OMG, it's cratering, you know. So kind of like at the beginning of the year, this one was, I believe I said, a 2 shopping cart buying situation. And now, like I said, I don't want anything to do with this last 10% to quote unquote 2,400 if we get there. Okay. Even though I have the stock market doubling, okay, it's just going off of history. From here, I just the whole sentiment after Brexit, and then the running that we had. You know, we're facing an interest rate challenge here. A lot of us haven't dealt with interest rates going the other way. We saw that with the housing numbers, and they took it out of the builders and the banks. Okay, housing number, they stalled. Okay, so the only way we can sell new homes is 2 ways. One, we build a smaller home because people have a payment, and it's whatever they can afford. We have a lot of existing homes because of baby boomers, and they will be downsizing. Okay. I always see the top in the housing market is how big the homes are. I talked about Summit Avenue in St. Paul. Like the homes were built in 1927, 1928, 1920, just humongous things. Because at that time, the families, extended families, brothers and sisters, they all lived together in these big homes because that's what they did growing up. When you were in a sod home out on the plains, everybody was together. Okay, and that's just how it is. And then all of a sudden 1930s roll around and the homes were much smaller and without a garage. Okay. And you saw some of that after the post-war years too in the 1950s. I grew up in Bloomington, Minnesota, where the Mall of America. And the homes in the 50s were smaller. In the late 60s, during that peak in the real estate market, they were bigger. You had your multiple level 3-bedroom ramblers. And then in 1987, when we hit the high in the real estate market, these things were 3 stories tall and no one was living in them because you just had to hold on for X amount of months and flip it for 30%. Okay, now that's the other one too, that's the second one is to have the houses go up in value. Okay, if they go up, say 10% a year and interest rates are at 6%, you're making money. Okay, that's where after the stock market rolls over, kind of like in 2000, the money will have to go somewhere and it'll probably go into real estate. Okay. Okay, so we have frothy call buying down here also. And then this is the indexes. Okay, indexes came down the same way. All right, sideways down a couple of hundred here, 100 here or so, right? About 100, 150. Okay, don't know why that line is there. And then a few others here where it was sideways and then it went down. So I'm leaning that right now that at best the market would trade sideways. Okay, we're also getting to the slow time of the year with the holidays picking up. But if 2243 is lost and the futures, I would say that we're going to reverse. Here is a point and figure chart for the industrials. I'm looking for this volume area here. Right now, 19,895. You know, people will start talking about, you know, NASDAQ 5,000, you know, Dow 20,000. Those are just numbers, but you know, it's one of these things where you get close. You know, you're within 25 points and it doesn't hit. Okay, I've seen that. The oil went to 49.90, I think, one time. Didn't hit 50 and then dropped $10. Okay, so I look at this as this 19,895 as overhead resistance for now because there's a lot of volume and we're trading below it. And then this 19,776 is would be a level of support. Okay. Basically, if the Dow loses that, then I would expect that it would come back to this trend line. All right, this is post Thanksgiving. Okay, so this is our point and figure. Basically, just takes price. You guys trade price. All right, so this would be a support area. So the Dow would then lose about 300 points on here. Okay, then you basically go back to your line charts. Other thing as I'm zipping through here, this is Mexico, talked about on the short side of Mexico. This isn't the only country that's having issues. You can see that Mexico kind of broke out and failed, and now we're kind of working on a bear flag. So if we have NAFTA, right? Mexico's not working. You know, will we import their issues? Back in, I believe, 1996, Mexico, I believe, devaluated, whatever. It screwed up the cattle market a lot. This, you know, on the way up to the peak in 2000, we had multiple 15% pullbacks. Okay, even though we all remember the thing went straight up, there were a lot of healthy pullbacks on here on the way up. So same thing again, you know, right now I have to lean that we're going to at least trade sideways to lower coming into the inauguration. Here is what I did was I took the Nixon roughly drop here. This would be back to Brexit low, okay, because this is daytime trading, okay. So on the New York Stock Exchange Composite, which also now, this is on a daily, kind of is making a bear flag on here, all right. You know, there's a lot of swing, not a lot of money moved into the New York, moved into the S&Ps, they moved into the little guys, the Dow, of course, which is 30, and then the money's trying to move into the NASDAQ, okay. Here's the NASDAQ down below. The NASDAQ then would be roughly 4850 from 54 to 48. So that's 600 points there. The dots here, the summation index. So this is the number of issues that are contributing. Okay. So basically, after Brexit, all right, we had the swing higher. Now I had this going on behind it. So this would be known as a running correction. Okay, but prices continue to move higher, but the number of issues it was faltering. Okay, and the two theories here is that one, the issues have already corrected and they can run higher, but we kind of stalled out here. All right, this is coming off of the low of the beginning of the year after the first rate hike. Okay, and then, you know, I look at it as this whole big picture here, okay, of what happened. You got up to Brexit and the issues started falling apart behind the scenes. If you run through your portfolio, if you're not an indexer, you'll probably see that a lot of these issues have just collapsed, okay. What we're waiting for is for the obvious, you know, for the main indexes to roll over. A lot of issues have taken it on the chin. The thing here is you want to look for what you want to buy if we do get some sort of pullback. it would probably be housing, okay, because what would happen is people would run back into debt. Housing, and then your banks and stuff. If the macroeconomic cycle continues, the only thing we have to worry about is politics. Okay. In my eyes, that's what it's the flicking of a rattlesnake. You know, it's here nor there, but it's one of these things that because all of this is, you know, as they say, this is fear and greed. But remember that we've moved, you know, for an extended period of time. You know, 8 years is the length of time that we received under Clinton for an expansion. You know, 1992 to 2000, and then Bush came in, and we had a pullback. 2000, 9/11 caused us to drop interest rates to what was it, a 90-year low. Okay, so we went from one extreme. Now remember also Japan itself, the sovereign they own like 60% of the stock now. So, you know, toss out the textbooks. Okay, so, you know, it's one of those things that you know, one day everybody's euphoric, and then the next day they'll just call it profit taking. Okay, so it's one of these things that, you know, you're watching on here. The downside is, of course, is you're watching the market go up and your portfolio going the other way because you may have the wrong issues and things of that nature. Like I said before, the stronger dollar is going to cause problems, just mathematically. Unless they hedge, it's going to cause problems. And if we try to isolate ourselves, it's going to exacerbate things even worse. Like I said, you know, you can say, China can say, hey, you know, no cans of Coca-Cola, you know, things of that nature. I mean, this is very delicate what we're doing here. This isn't a time to be creating disasters. But like I said before, you know, here's the initial 12% drop. I think it's on this page. Okay, here we are. So here's the S&P. The December contract is off the board now. Okay, so everybody is going to be into March. And what happened in the March here through December and the rollover is that they're going to be net long because the trend is up, right? So here this is, let's say 11.1. So I guess it could go a little bit lower here. This is pivot, okay, for this year. It's already listed pivots for next year. If we go higher, okay, now remember, the bodies aren't in the S&P, okay, but they definitely are in the Russell, okay, and the Dow, and then not as much as, let me take a look here. They're in the NASDAQ too, but not as much. Okay, the NASDAQ's, the bodies go in, but they're not getting much bang out of it. And if you look at the underside, we just looked at Priceline, you have, you know, there's difficulty here. So how I look at it, and how I've been looking at it since post-Brexit, is where we're at in the cycle is the small caps and stuff, the ones that have been beaten up. They may have peaked in 2013, 2014, 2015, that kind of thing. I did notice that the railroads have rolled over too, okay. And then there was a chart, I think last month, about truck sales, and that's dropping. So, you know, we have a situation here where, you know, 2017 should be good times economically, but we're beginning to stall. Okay, because of when you get to the tail end of things, like I said, the real estate market peaked in December 2005, but the stock market didn't peak until October of 2007, which was the only time in history that the stock market peaked in October. Okay, so here is an 11% drop. That would take us back to the election low. Okay, so if here's 2243. If that's tossed out, the first test, they're going to test this first breakout area, right? They broke out, they retested here. They would probably pause again, okay? Usually what happens is here, then you could have basically a head and shoulder type deal, okay? You're going to have people here who are going to want to sell into this thing, okay? To me, this is just a goofy pattern, okay? But the angle of ascent, and I believe this is logged here, the angle of ascent is sharp, okay? So that's it's easy to draw the trend line in here. But like I said, if it, I don't think this is going to hold because of just the put call ratio in itself. Then we go and we test this area, and then we would probably test back up into here and then roll over. But you still have to get through Sunday and Monday. We did have quad witching Thursday and Friday. Usually what happens there is there's a reversal of what happens on Friday because people wake up that have sold options, say if they had spreads put on, the onesie twosie guys, and wake up now with stock, either short or long, and they have to get out of this thing. So you have an issue with of people who have to, because they don't have the money. That's one reason why people do the options thing in the first place, is they're not well capitalized. And the toughie on the option thing is how much you have to pay in commissions. Say if you pay a buck a contract, okay, so we're talking a penny a share there. So, I mean, if you put on a spread for 50 cents and it goes to 65, it's, you make, say, 15 cents. Well, 4 cents of it is commission. So now you're down to 12, so now, you've lopped off a third or a quarter or whatever just in commissions. So those are toughies. I'm a big believer in, if you're long and you want to sell some options against it, you can put in the money ones, that kind of thing too. You just have to be willing to face the reality that you could lose it. But the deal is selling with the options, like I said, is even if we go sideways for a couple of months, then you'd collect that premium. And I usually say 15% out. I don't know what you have. It's kind of like I'm hoping you don't get your stock gets called from you. So I kind of, let's face reality here. If your stock goes up 15% in a quarter, that's a year and a half's worth of work. We're all getting used to seeing some pretty outrageous moves here. Okay. So, you kind of have to get back to normalization. Like I said, we're raising interest rates. Banks will put money into circulation. That'll cause, more inflation. That's how it feeds on itself. But then at some point, within a couple of years, the market freezes up. Here's another one too, is you have Apple with their money that's overseas. If you do have a holiday and bring the money back, most people would look at it as that's bullish, but then you don't have anything else forward. Apple's selling fewer phones, kind of thing. So it basically would help them for one day, and then reality would set in. Okay, that's December. Okay, here's my biggest concern. Going back to the 1930s, okay, my grandfather was a trust attorney in the plains of South Dakota. Okay, he charged a lot during the dirty 30s, that kind of thing. All right, so he accumulated stock, okay, and then that was passed off to my father, and then that will be passed on to me. The problem is you have all of that, okay, and we're at a period here that we're dealing with the baby boomers, okay, they're the largest segment of the population. They're going to come out of the workforce, okay, and we're going to have to replace them probably with robots, but we're still going to need bodies. My biggest concern is that this is the end of multiple generations of wealth. Okay, old issues, you know, the hubris falls out and new issues come in. That's true. But here you have 2000. So this is the baby boomers reaching the early ones, what, 55, going into their 60s. Okay, then this was basically your real estate run and also commodities. Then we had the unwind of everything in '08 when housing blew up. We had some more run in commodities, and then they came off. And then this was low interest rates and stock buybacks and that. So I'm kind of looking at it at this from the Great Depression. Here's like the big three. This was the long run. And then we have four. Okay, 1, 2, 3, 4, like, you know, ABC type deal. And this is our last hurrah. You know, like I said before, 10,000 people a day go on Social Security, and we're only making 3,000 jobs. So we already know we're going to have to cut Social Security payments by, I think it was 23%. Okay, so that's why in 1975 and that we said, hey folks, you need to do these KEOs and IRAs and, you know, Roth, all these, you're going to have to figure this out yourself, because of just doing the math, we know we're going to run into problems. And now, like I mentioned before, the largest purchaser of U.S. debt, Social Security, okay, and we were running on low rates. So we didn't want to tell everybody that. Well, the people that are working aren't going to, you know, I was lucky to start my career at double-digit rates. You know, people starting today, they're not going to be as fortunate. But my biggest concern is overall in general is that we actually begin to correct the entire move from the 1930s up here. America one time was, I remember, a third of the world GDP. I think after World War II, we were over 50%. And that's when America was great. When everyone, you know, they were in unions, they could get benefits, they could, a one-parent household. And then the 70s and 80s rolled on. And then all of a sudden it's a two-parent household. They're never home. Kids have to fend for themselves. Just a lot of change here. Okay. But like I said, my biggest concern is that we actually, we don't correct from here, which would probably put us around, even a 50% pullback would probably pull us around 1600, and retest here is that we fail this and drop even further. Okay. We did get to 666 down here. So going back to 500 wouldn't be a problem, right? Okay. In 29, the market lost 89%. Okay. I'm not saying that it's going to happen. This is one of those things I worry about in the larger scheme of things. Okay. So, but for right now, you know, just draw your trend lines. The angle of ascent is high. If we do trade higher next week, or to the end of the year, these pivots will adjust. Basically the pivot is basically the highs here at 21. What's that? What does it say? 2115. But like, you know, once you start getting to 2200 and that, you know, my thing is if we lose the 2243, we're going to set up something of a deeper pullback here. But for right now, you know, with the lack of people in the S&P, they can come in. But if you look at, let's see here, can I do that real quick? Let's do this. Oh, let's see here, how do I do that? Come on, you. There we go. Yeah. Come on, you. Come on. 1,000, 2, 1,000, 3, 1,000. I did do that, you goofball. Well, it's just not behaving for me. We'll try it again. All right, you. Why can't you connect? What don't you like about me? All right, we'll have to fix that, but we'll go through the futures anyway, and I'll just point it out. All right, so on to the futures. Okay. Sorry about that. Okay, so we're going to run down the futures on here. All right, here's the Mexican peso. All right, so we know that there was a hard. This would be the strength of the peso, which would mean if this goes higher, the U.S. dollar Mexico go lower. Okay, we saw that the Mexican stock market was having issues. This was a momentum low. Okay. And you can see that we're basically trading sideways here, okay? What I think is going to happen is a lot of these emerging markets and things of that nature are going to come under pressure here, okay? Same thing to go along with Mexico. You know, what you do is, you know, it's kind of like buy the rumor, sell the news. You already have it here. And you have a large amount of selling that's been going on for an extended period of time. Let's see about this one. See, here you go. So here you have multiple years of selling of the Mexican peso. You get the election, Trump comes in, you know, there's our news. And, you know, it basically lost its momentum and it's trading sideways. The flip side is if you short this pair, you get the carry trade. So you collect the interest. I don't know what broker you have, but that's part of what is the currency market's all about. Is in America you get 50-to-1 leverage. Okay, so if you put in $1,000 at 50-to-1 leverage, it's 50,000. So you're not collecting interest on a daily basis, what have you, depending upon your broker. On $1,000, you get paid the interest or charged it at 50,000. Okay, so that's how that works. Some of you guys that are overseas get higher leverage. You throw in the leverage, you throw in the bid-ask spread, the spread's widened. It's, you know, it's one of these where, you know, you can get chewed up before you even get started. But on the Mexican peso here, it's one of those where it's been moving down for such a long time. We finally got the news, and it's stalled and it's trading sideways. So it is susceptible to a reversal. And that's what I'm watching for on here. We did get some action both ways on Friday. We had a stronger dollar. Dollar's at a 14-year high. The next target would be 105. But a lot of markets, as we go through them here, basically bounced off of their weekly support levels. Here, the Australian dollar, this is going to be a lot of overhead supply. Also with China rolling over, okay, Australia sells a lot of material, coal and things of that nature to China. In my last video, my opinion video, pointed out China not doing so hot, right? Okay, so Australia, plus also the whole carry trade there, when our interest rates go higher, you're not going to want, say, like New Zealand. New Zealand was the carry on the way up into 2007. They also played the euro and the pound. You know, people remember, you know, the pound, Japanese yen just going crazy. Okay, so here we are with the New Zealand dollar. Same type of deal. U.S. raises interest rates. This isn't as desirable. Okay. Then we go back to the British pound here. Okay, the British pound. All right, so we initially got in down here on a heavy volume day. Let's see here. Where am I looking for? Okay, we got in on a heavy volume day. Okay, so we're down into this area. We moved up to the first line here. We moved up to the second line here. If there's any strength in the dollar here, this would probably be a retest area, okay, and trading sideways, okay, because this is holding up in relationship to the euro. Now the euro's it was trading around 104. People are going to talk about parity, just like we talked about 20,000 on the Dow, around 5,000 on the NASDAQ. You might not reach the parity. Okay, that causes issues overseas if their currency drops. You know, we're back to the whole import-export thing. bananas cost more money, coconuts cost more money. You begin to have issues with this. Currencies, like interest rates, they trend for a long period of time. Okay. In America, for interest rates to go from their lows to their high took 30 years. That's longer. Usually it's around like an 8-year cycle. We raise interest rates, and that causes the dollar to go up because people want to capture that yield. And that's when we talk about the carry trade. So it's, what we really do need to start the cycle again is we need something like what happened under Carter, where we had high amount of interest rates, because then what that does is that sets up a longer cycle of housing and stuff. People can refinance and things of that nature going forward. But like I said, we have just a small difficulty with population growth. I think America was down to 1.8 kids. People remember saying 2.3. We're down to 1.8. Mexico is down to 2.8, which is what America was in the 80s. So we're beginning to see even things begin to slow down here. But on the British pound, we're back to the 123 area here. But I basically kind of look at it as a sideways. There is talk of 110. If that happens, then definitely the euro would probably be under par. And then that would also mean that interest rates, again, are moving at a clip, and that will definitely cause issues with equities. Okay, it'll be spun as rates are higher because the economy is stronger, but we're pulling forward sales. People would panic and hurry up and quickly buy this stuff because the stuff is going up in price. All right. So a lot of this now is macroeconomics. But I like I said, I still like the pound. I don't know if it'll go to 110. Let's take a look here. Right now it can be being held up by the crosses of the euro and the pound itself. Canadian dollar. Now this one is still moving. This is a longer flag than I'd like to see. Obviously the bodies are in here. This would coincide with oil. Okay. You do have somewhat of an inverted head and shoulders here. Oil, we did have a contract rollover. So 52 was the short-term cap for the rollover. Now it'd be back to 54. Like I said before, if we have any issues with politics and the oil clips 54, then it'll head to 62. Okay. And then that will begin to cause issues too, because money will then be pulled out of the economy through oil, and we won't be able to buy any goods. We were on our way, economically, and then we kind of ran into a wee bit of a rut here. This is the third time. Usually you have double bottoms, triple bottoms, the whole, you have your W thing. This is usually going to crack. Now what happens is it gets lopsided with the commitment of traders, and it goes the other way. All right. So we're getting the dollars right now. I'm not saying it's frothy, but the next target would be 105. But if we could cool the jets in the dollar, that would be beneficial. We don't need the dollar screaming, because then that's going to cause, issues. Briggs had helped out, the people who are in contracts with the pound. Let's go back to the pound real quick. You make long-term contracts, right? You make long-term contracts. Now your currency is falling apart, but you're locked into these long-term contracts. So what you need to do is get out of these contracts so you can reestablish your money, okay? Because if here's 2014. If you're in here and saying, okay, I'll buy X amount of chocolate for you, with the pound at $1.70, and all of a sudden it gets down to, here's $1.50, that it costs more to be able to buy the goods. So what you do is you pull out the Brexit deal, That allows you to go and start busting contracts, kind of like when companies file for bankruptcy, they get to break union contracts, okay, and those kind of things. So, you know, that's basically politics. Is they can get out of their contracts, which of course causes issues with the people on the other side because they have contracts with their people with contracts, right? So you begin to shake the tree, something a little fierce. The dollar, you know, it's been going up for a while, like what, 2012. So the dollar's been going up for 4 years now. So it probably has another 4 years, which would coincide with the recession. Okay. And a stronger dollar should pressure commodities, but we've seen that it's not been happening with oil. It's been on its own way here. Here's Brent crude. Okay. You can see here about 54 would be a support area on Brent crude. It did close above pivots. This would be about 55.70 would be, at best, you could say that it's a shoulder, head and shoulder. Okay. Things are going to get interesting down the road. You know, this is Brent. Remember how Brent widened versus U.S. crude? I think $15. Okay, and so now we're what, a buck and change, $2, that kind of thing. So if there are any issues in the Middle East per se with oil exports, it's going to affect Brent more. Okay. The same, like I talked about in my opinion piece, the same type of thing would pan out where you get an artificial shortage of oil, you know, from the news and the selling. You know, I'm going to lean that at best right now we're trading sideways on this. We're going to have to give this a little bit of time. But if oil does take out the previous highs on here, then we have more going on behind the scenes than what's there. You know, I'm seeing oil go up, but gasoline come down. You know, locally here. Cocoa had just having an awful time finding a handle on here. You know, my thing is it doesn't trade 24 hours a day. It's had some when you get wide swings, you end up going sideways for a period to kind of cool things off. And that's what we might be facing here in cocoa. You can have unrest. Cocoa's not produced everywhere. You can have unrest, shipping, dock workers strike, blah, blah, blah. But just the way that cocoa's rolled off, I believe it's still in a bear market. But you can see that the bodies came out of it. You know, you had people trying to fish for the bottom. The 2420 would be the happy place where it's going to find some overhead supply. Crude oil, ours again here. Basically the same thing. If it clears this high with this type of selling that went on with the news, okay. If it goes above the high, I would be concerned for a few things. Bond prices would probably continue to go on. You could have the Fed come in early and raise rates again. That would cause some issues with now we're dealing with inflation, okay, because this will filter through. You know, you go from one, you know, but that's how it works in the markets. You go from one extreme ZERP to the other extreme where now we're dealing with inflation. Inflation mostly in the United States are wages. And the baby boomers come out, and the poor people that are educated, the millennials, have been, you know, you're going to have to convince them. I remember at the top of the market in 2005, and that they'd actually publish what the salaries, what they were, to get people to get them off the couch and get them. Yeah, you have, you know, it's one of those things that you're able to, you know, survive on one income, you know, and you get into that rut, you know. But like I said, the boomers start coming out of here, and all of a sudden we're going to have shortages. You know, the boomers held on. A lot of them, you know, they you know, at one time America worked for retirement. Now they they're scared to death that they need to work in their 70s just to be able to make the copay, so well, if we're going to see it, we're going to see issues there too. People are hiring, they're training, we're trying to, we're looking forward, but you also run into spot shortages. But I'll treat this right now as head and shoulders for right now, but we'll, see going forward. Like I said, if oil clears 54, then it's on its way to 62. You may end up with just a double top up here too. EIA, things of that nature. Seasonally, this type of year, we don't really, we do drive to grandma's, but we're not, it's not as strong. It's kind of like the driving season. Cotton, I looked at the commitment of traders, and the big traders they're pretty long on this thing here, so it's susceptible to any collapse, just kind of like soybeans. Here's the happy area. This isn't too clear cut for me. Basically, all I say is it's trading sideways, and you'll get a trend to break out. It tried to break out, couldn't hold it, came back in, so then you have to kind of lean on the short side of things. The dollar index. Okay, so the dollar traded sideways. We broke out. Okay. Like I said, the next level is about 105. I'll look at another chart, but about 105. But we're at a 14-year high, and there's going to be talk about that. This all happened. You go from 95. The same thing. You have contracts with people, the dollar's at pegged at 95, and all of a sudden it's at, 103, 104, 105. That's 15% more, than what in your contracts. So you could have the reverse Brexit where all of a sudden, contracts begin to get broken. Sounds familiar, doesn't it? And, for us setting up contracts to buy out from people overseas, we'll buy X amount of sulfus from you, we'll buy X amount of, trade type deals, and the dollar takes off. That's our benefit. Okay, breaking the contracts, that's not going to benefit us. All right. So it's like selling a winner, breaking a contract, especially with a strong dollar, If we say we're going to buy X amount of coconuts from you, at the dollar at 95, and now it's at 103. Hey, we have a better deal, right? we're going to sell the winner. That's kind of how I look at it. EMD, you can see how the money ran into it. Okay, this is mid caps. Okay, so this is our run up. This is our secondary breakout. Not as much money. So this is where the put call ratio came in. The people ended up buying calls, and they're not supporting this. Okay. Like I said, I don't think this stuff's going to hold here. If you're a trader of this is the happy place, 1628. I don't think this will hold. I think we'll end up falling. Okay. If we slice this through butter, run to the hills. That's how I kind of look at that. Did I skip one? No, next one. S&P. Okay. The upper range is around, I think it was 82. Okay, the pivot's on here. What do we have here? 74. The high was 73. So these are both daily and weekly resistance levels. Okay. Like I said, the money, where was it? Daily? Is that the one I have it on daily? Where am I at? 4 hour, no. Well, you can see it here. Okay, we'll just point it out. So you have the money flow, right? The market takes off, the money comes in, market goes sideways, people can't really figure it out, the money comes out of it, the market takes off. Okay, it cleaned them out. When you go from minus 700 down and stuff, when you have large volatility like we did on the election night, it cleans them out, and the market took off. Then they got it. Then the first pullback, they ran to the hills. Then the money came in. Okay, the deal is the price is higher than the previous high. Okay, but with less money. So basically, how I look at it is the onesie twosies were hitting the market button. Just get me in. Just get me in at any price. Okay, now here's on the daily, same thing. Market comes down, money comes out, market goes up, money comes in, same type of deal. Somewhere around post-Brexit, the money did not come in. They did not want anything to do with this either. All right. I'm going to assume that that's the people in the know, right? Okay. They know, it could be anything. The interest rates, we had the peak in interest rates post-Brexit. We're going to hear about earnings, and if it affects one, it's going to affect them all, that kind of thing. And this is the S&P, but the money that we went to a new high and we barely got any money. So in theory for me, okay, is that the money can come in later. Okay. So it may be a time thing that they're going to wait into the first quarter to see how earnings, and then they'll come in. But just the fact that, we had this run up on less money tells me that this is probably a lot of onesie twosies in here. Okay, these are just, they saw the Russell take off, then they got into the S&P and the Dow, and then all of a sudden, the NASDAQ is trying forever to try and hold its way up. But I look at it as, like I said, it loses the 43. The next test area would be about 2,200. Okay, that's 40 points of air. Okay. That's a kind of a difficult slide, and that would be the top area here of, this is where 70% of where the trading is happening in the shaded area, okay? This would be a logical pause, okay, on here, because this was the resistance level. They broke through it and they retested it, and they said, hey, it held, and we're off and running. Well, how I look at it, the put call ratio, the money's not there. There are a lot of people besides myself, who just aren't interested in this thing here. I personally don't, if we pull back all the way to here, that's going to be one heck of a bar. That'll be one hell of a red bar on that on a weekly basis. I chatted with one guy, I think on Friday, talking about how this could be a monthly reversal. Like if January comes down, it takes out, all of December, and then you have what is known as a bull trap. Okay. And like I said, down here is where, that first Nixon decline before inauguration, the market tanked. Okay. So, then then it did go back up and retest this area. So we'll, when it gets here, if it gets here over the next end of January, we'll then, obviously we'll discuss this thing here. But that's how at best, it's going to trade between, say, 2,200. Okay. And then on the upper end, which is going to be new highs. Okay. There's my 2,400. All right, we do have the end of the year, but that's mostly stocks that have been beat up that they buy, and then they run them into January, the Santa Claus rally. You have the whole tax deal, tax loss selling, things of that nature. But, the market's been going up since 2009. So, I'm viewing any type of top on here. We're gonna correct a lot of what we've moved. I mean, at the beginning of the year, we were at 1,800, and I was looking for 2,400. But like I said, post Brexit, I'm not interested. The sentiment was just, now they're getting excited about the stock market. Where were you down here? And I'm worried up here. So. That's that on that one. So basically, like I said, it loses here. It's going to a bunch of error down to 2,200. But I'd look at that as just a fat weekly bar. One thing that can happen is all of a sudden, because of the end of the year, you begin to get short daily bars of short covering, just chop into a bear flag. And so that's that on the upper end. Use your daily, weekly, and then 2 hour type things. But like I said, I don't it's not clear cut, right? I mean, you have to go, you have to clear this and then here, that's probably where the money would probably come in then. But, once we go through all the rest of these here, you'll see that, that the money's already in there. Well, I guess I can do that while I'm still at it. Okay, so then you have the Dow. You can see, okay, here's daily. Okay, so the money comes in, the price goes up, basically trade sideways. Nobody wanted it over the summer when we hit the high in bonds, the low in interest rates, and then the dollar took off. This is what happened when interest rates turned. Okay, they immediately got out of equities. Okay, then we had the post-election. Okay. Remember, prior to this, we talked about the gap and go, too many put buyers. And before this happened, okay, too many put buyers. Actually, it was in here. There were too many put buyers. We went the other way. Since we know 93% of options are either covered or expire worthless, it's like life insurance. It only pays off once. And that's, of course, if you tell your children that you have it. Or your lawyer. One time in my life, I worked a class action lawsuit where the mutual holders, it was a mutual insurance company, so the policy holders, they ended up suing themselves, and the attorneys got $200 million out of the deal, and then the company went public. And that was, I think, back in 20 years ago. It's been a while. But that was when we were moving from mutual companies to public companies. So they basically, everyone could get a paid up policy after 10 years, but interest rates dropped, and that was their excuse to have you keep paying after that, and then they started suing. But the same type of deal. People who buys options, right? The people that think they're going to get 3,000% in a week, okay? Because you see it. It's kind of like the slot machine thing. You put in a couple of bucks, it spins around. Oh, look, you won, and then it's over with in your wallet. That kind of thing. Same type of, you see, when you open up the paper, they don't show you the biggest losers, do they? This is the biggest loser. This is the biggest loser. This is, the most amount of fools are in this one. They don't list it in the paper. They only list this one's up this much. This one's up this much. And it's like, oh, if only I chase after 7,000 different stocks every day. I prefer to buy. If I'm long, sell options out of the money. If I'm tempted to sell an option, you can pick up some premium. That the whole thing is to stay in on here. You can see here, the money came out of it, and then it ran up, and then the money came back in, but it's still below the previous level. Okay. All right. The other one you can do too is, say, for example, you can buy the futures and then sell your cash underneath it too, couldn't you? You just keep buying the futures, buying the futures, buying the futures, and then sell your stock underneath. Okay, follow me on that one. All right, so if you're a big fund or whatever and you want to get out of your stuff, you can go along with the party on the future side and then sell your cash underneath it. So as this is going, you kind of look at it as you're beginning to see cracks. Your whole portfolio is pegged, and all of a sudden you begin to see cracks in it. Okay, because there are only a few sectors that are working here. How are the drug makers doing? How are the biotechs doing? How are the transports doing? Like I said, I saw rails rolling over. We may be at the beginning of something here. But the body's moved in here. Okay, so they'd probably be willing. What's this here? 19,684. 684. So 80 points lower. This would be as you can see, little nibs here of areas where where it would pause. They'd come and test this, but these would be fat bars. Okay. And then you're back into this area. Well, there you are. There's a lot of volume over the summer. This is where you get people who would go, okay, I'll buy in here, but then all of a sudden you're working the bear market. I'm not saying we're in a bear market yet, but I go through a lot of charts and they're all pointing lower. Fewer and fewer of them seem to be going higher. You know, they all just seem to be rolling over. And we're facing a strong dollar and we're facing interest rates, something that the market hasn't dealt with in, what, 8 years? 9/11, what's that, 15 years when we had to crack rates even lower, you know. So that's that one. And then what do we got? The NASDAQ. Okay, so the NASDAQ, gosh, I really want to lean that this is going to be a trap. Same thing again here too. You know, the money comes out, the price goes down, money comes back in, comes in. All of a sudden, it's just, you know, they're trading higher on the money. They're just not willing to commit. Okay, folks are just not. Oh, new high, but yet you're not seeing it here. So I have to lean, and just how I mean, this was the leader on the way up, the NASDAQ, and now it just can't hold it together. I mean, go look at your Google and your Amazon and things of that nature. You know, some of them have already had 5 waves down. Okay, so you know we're facing trend reversals here. Okay, but the bodies just didn't want this, whereas in the Russell, you can see here, you know, money and everything through all good correlation, bounced off the low. They chased after this. This is the folks going, oh yeah, that's right. We get the Santa Claus rally and the little guys. We get a spike up in money flow. And then we get a pullback here. Okay, to me, I'm thinking that this one is going to hold up here. It's 19.4. Doesn't mean we can't have a double top and then roll over. If you look at intraday, like the S&P, let's see here. You can kind of see it, what I'm talking about. Let's see, so what did I have that on? Let's try it this way. Intraday, does it give me the tick? I have to change that. Don't die. What am I looking for here? All right, intraday, 5 days. Oh, time, tick, right? Okay. 5 days. I think it's 3,200 ticks. I think I have it on 16. We'll take a look here. All right, so Wednesday we have a double top on here. Okay, right. So you know you have a double top and it breaks down. You get a lower high, lower high, lower high. See, now here's your green, which is the support area, is back down to you're at the lows here. So this is basically kind of like this is the last. You're gonna get mechanical on here. The double line here means it's both a daily and a weekly pivot. It closed below it. Okay. This is a happy area 52. So if you want to get started on the selling, this would be like your first alarm. Let's take a look here. 51.75 works. All right. That would be, and then this is basically, you know, 43 is what I was at. Your computers are going to be with the pivots. This is a support level at the lows. So, you know, it's one of these things that the bulls, they have to get it going Sunday, Monday. If they don't, and they lose this here, if they lose the 40 area, 40, whatever, 43, we're dropping all the way to 2,200. That's going to make a nasty looking weekly bar, right? You basically have I'm going to have to treat it as a bull trap, okay, on a short-term basis here. You know, think of the stock market as one big bell curve. You know, it's tough at extreme points, at the highs and the lows, because of you get people who just get caught up in the frenzy. I mean, the prospectuses in 2000 said that these companies were never earned a nickel, and they in their future they don't ever think they're going to end up a nickel. The stock is listed at $30 and comes out at 106 and goes straight down. That's the type of, you were warned. You know, I've had friends come to me and they said they wanted to buy GM stock. And I'm like, you did sign the piece of paper that says that this thing's going to zero. It's another thing that they file for bankruptcy and the stock still trades. Grr. All right, so take a look at this here. So you have your money flow, right? You go up and you make the high, okay? The money flow kind of came off. Then you see it tried another shot up here, and there was more money, but you got less. So that told me that the ones and twosies are anticipating a higher high, and it didn't happen. Okay, so now all of a sudden, you know, you're getting, you know, on a short-term basis, you failed to make a higher high. We'll treat this as a double top. Comes down. More money comes flying into it, and it doesn't, you only get so much. Okay, so you were meeting a lot of selling into this here. Okay, a lower low, lower low. Once I gotta believe, once we lose this down here, you know, there's going to be some air, and it's going to look to be a nasty looking bar. And like I said before with the Nixon deal, they didn't even wait for him to get an inauguration before they started the selling, and the selling continued on for the next year and a half, and the market lost a third. I'm not saying it's going to happen. It's not, you know, it's not that I dislike POTUS or whatever. I'm just pointing it out. You know, it's like the stripes on a zebra. You just can't change the thing, you know. And it's here nor there. You know, I've in my lifetime, I've dealt with people who understand economics and some that don't, and some get the benefit of the business cycle and some don't. And then some try to, you know, help themselves, you know, in the position of governing, and it hurts others. There's, you know, it's kind of like the Chinese symbol for crisis is also opportunity. So, but, you know, to me, you know, they ran up and the money stopped. They tried another time, less money, came down here. They gave it a good go. More money came in, and it's not working. I'm going to have to assume that 58 and that's going to try to be overhead resistance for tonight. And these are resistance levels 69 and up in here. But it's one of these things that, like I said, if it loses the 43, it's going to be a big bunch of error and a nasty looking weekly bar. And then I suppose we would have to look at some sort of monthly type deal. Okay, what do we have here? We have like a Harami cross. All right. Can I do monthly bars? All right. Yeah, let's try this. So where are we at? So here's 2,200. So you could end up, oh wow, you could end up with a monthly bear trap or bull trap right here. We go back to 22. We're going to clean everything out for this month. What's this level? What's it say for the low? 2180. So we're back to that game again. Yikes. All right. So that's your story here is, yeah, 2220. Yeah, just like it's be very careful. I'm assuming a lot of you have already purchased some puts distance out. You've already nibbled on like SDOW and SPXS. Like I said, it's difficult for those things near the end because things get so irrational. Okay, you know, I'm not saying that, but like I said, you know, if it loses, there's a bunch of air, and now you're going to be talking about, well, you're going to leave, you know, you're going to leave a bunch of bodies here. You know, now you can see all the money coming in, you know, all through 12, or all of a sudden it just kind of gave up here in 14, 15. The world stock market's topped. You know, you make a go for it here, and just the money's not, they're not willing to go in there. There's 2050 is a happy area. 2056 is the happy area on a monthly basis here. Gosh golly gee whiz. This is going to be an interesting end of the month. All right, moving on. All right, gold. All right, so, okay, gold. We did get some washing out of the equity side of things, because I still had people emailing me about, what what do you see? I need to dig myself out of Italy. Well, it's gold's doing its thing. All right, so we found an area there, and the money came flying out of it, just like it did earlier this year. It's one of those where, we talked about what's August, September, October about JDSU, or excuse me, JDST, I believe it was, right? Yeah. All right. Buy zone. Okay. Well, that's kind of a goofy looking chart. All right. Yeah. I got the buy zone coming in. Okay. It's one of these where because of how they act. Yeah. How they act. For those of you that got in, I'd take some money off the table here for right now. Just the whippy behavior usually means that there's a trend. You saw the money come in, and it immediately came out in the reversal. So I would, because how these things are calculated, in theory, you should play the short side of all these things, especially if they ever go over 200. They never. It's just how they're designed. Basically you're playing it for swing. These are kind of rarities. I suppose you could say this is 1, 2, this is the third move, and this is the fifth move here. Like I said, the gold doesn't have to be bullish. The bears can be wrong. Okay. There's just, say there's too many of them. Okay. So for those of you that are in, months back, I would, all right. So you've gone from 22 to 70, and here's the money. And you're back into the meaty spot here. All right. See, it comes down to, it's been pressured. Gold's been pressured with the dollar. Gold's a currency too. But it's one of those, just the short-term behavior, kind of like, all of a sudden it comes back down to here, and then gold decides to drop. You don't get as, because of the calculation. It's kind of, when I wrote about if you take half off, you still, you're in from, you're in from wherever I said to start looking at this thing. Down in this area, you've had, if you take half off, the bodies are in here. They look like they puked up their shares on Friday. I'm not saying that, that it won't continue, but what I'm saying is that you've had a pretty good, you've had a pretty good run on this. Even if you take half off, you still have it. I posted a chart about gold in 85, 86, 87. It traded higher. The stocks traded higher during a deflationary period. So, we could have the dollar go to 105 and then call that quits for a while. But the pain's already in. Okay. So that's dust. So I'm not saying gold's going to 1,500. But what I'm saying is that, you have a pretty good profit, take some off the table. You saw the puking of the stocks on Friday, but they're still holding up. From the lows on these, they're still holding halfway. That's the other thing too, is what happens if you get some sort of political issue here, and you have people scramble back into it. For my deal, it was once it lost 1250, it's going to head lower. But I can only do what the market gives me, the copper issue here too, the same thing, the hard run up, pullback, second attempt, and now we're kind of flopping over on the deal. The green lines here, the two of them, so this ended up at daily and weekly support level. Doesn't mean that it's not going to fall, but my thing is here's a median line. It lost it, went through the other one. You're looking at it as this would be a resistance level up in here. The copper and all of that, the commodities, they face an issue of a stronger dollar. And like I said, I look at a lot of these as a way for that they, once the dollar continues to go higher, it's going to pressure these things, because what you end up doing is you end up buying copper overseas versus pulling out of the ground here. They still, they collect it from old cars. They collect it from, we recycle, that kind of thing too. So, but there's a happy place in there. This one here, the copper was the one that waited all the way till October before it swung from the lows of this year. Okay, because the dollar will begin to affect these. This is kind of cool here. Okay, so you have the money coming in, but prices are lower. So maybe we'll get a stall here. For the greater good, I want to see oil kind of capped off. I don't really want to see things take off, because then we're gonna raise rates at a fast clip here. What you have to do is, if you're making the money at 10%, and even if interest rates are at 7%, you're still making percent, right? It's kind of like, we make a penny on, like oil, to them, they make their profit per gallon, the excise tax for the government per gallon. Some people fill it up, some people put in 5 or 10 or 20 and then conserve that way. Gasoline consumption since 2007 fell 75%. So what do we know? If demand is low, prices should be low, right? No, because we have fewer and fewer oil companies. We allowed them to merge. Exxon bought Mobil. They pointed to the 12 years of oil not going anywhere prior. Exxon, and then Atlantic Richfield, and on and on and on. They all merged, and then pa-ding, we're off to 147. So collusion, and that it's still USA Inc. here. But to try and tell them that you make more money on selling more gallons versus, we can pull it out of the ground, and yeah, I know. But for the greater good here, I want to hopefully see some of the oil and everything be capped here, because we can have things kind of run away. There's so much money out there. There's so much, it won't take much to trigger some of this stuff. And then definitely there's going to be some issues for equities. Cattle. Okay, cattle typically moves higher in January. I was looking for some sort of pullback, but it doesn't seem like maybe we'll get it here. But cattle, actually, they moved. They usually sell in October, and that for working in the fields, that and hogs and things. But both cattle and hogs took off. Remember that I believe the Chinese bought Smithfield. Okay, where am I at? HE, right? HE for hogs, Kev? Hogs, same thing for hogs. Hogs took off too. It is finding a gappy area in here. You have a happy place at 70 cents. Moving from 40 to 70 is quite healthy. So you could have this thing too. Like I said, Smithfield. I think they're number 4, right? And they're owned by the Chinese. So think about this one for playing games. They just decide to export all their hogs to China, and they don't, and all of a sudden they take Smithfield off the market in the United States. I mean, you know, I don't know what's coming, but I have to kind of speculate on things of that nature. You know, this is a significant move here in hogs, just also from the way down. But this is a significant move. I'd be kind of one to lighten the load here. You know, I did talk about it some months ago, but if I don't get any feedback, whatever, I kind of like move along. You know, most of it's whatever's du jour, the emails that come to me. You know, should I buy Apple? Should I sell it? That kind of thing. So it's a two-way street. You email me something, I'll take a look at it. Basically, it's more of, you know, for me to give your opinion. The worst one, of course, is when you are in something and it's been writing against you for extended period of time, you know, and then that's a difficult one for me because I have to come back and go, well, you know, a lot of us, you know, how you should look at things is say you buy hogs up in here, right? Okay, you buy hogs up in here. You start off with where you think your stop is going to be. You could say, oh, I don't think this is a contract change, but oh, I don't think it'll ever get here. It's just going to go straight up. Put your stop in there first. Put your stop in, and then do the whole, most of us do the same thing. We panic to get in. I need to get in. Then you hit the wrong order, the wrong deal. It gives you a screen. You know, it says, do you really want to do this? And you say, yeah. And then you do it and you realize, oh, I screwed that up. But I always start off with your stop. Okay, and things of that nature. All right, so now we're on to Natty Gas. Natty Gas, this is the entry down here on the Natty Gas. Natty Gas goes up. The bodies came out of it in here. Now we retest it. Commitment of Traders report. Holy buckets. Let's take a look at that real quick. Would you believe that they actually kept buying? Now, let me see here. CFTC, natural gas. Okay. All right, so this is just the first one here. Natty Gas, December 13. Now, this will be Wednesday to Tuesday's data. Okay. So the little guy added some shorts in. They bought some. Other reportables added lots of longs. They got out of their spreads. They got out of their shorts. They added lots of longs. Managed money. They added not as much, but they added longs. So that would have been Wednesday, Thursday, Friday. So they basically they bought Sunday and Monday. So they bought the dip. Okay. Swap dealers, they added shorts, and producers in that, they added shorts, more shorts than longs. What they're doing is they're trying to lock in the price coming out of the ground, and they also purchased the longs here. Or they purchased the longs. They added longs. You could have some, the long side, your refiner or utilities and things of that nature, trying to lock in prices. All right, so that was from Tuesday to Wednesday to Tuesday. Okay, so you have, what am I looking at? 4-hour charts here. Okay, so they bought in on this and they bought in on here. Okay, so this isn't in the commitment of traders, but you can see money. So basically, you had a lot of people who were they bought into this area here. Okay. The money did come out on Friday. We had a somewhat of a decent reversal bar here at a 4-hour. What it needs to do is the first issue will be back up into the 50s here. This would be your support area back into the 20s. I would assume this is a contract rollover here. Okay, I would assume though that some of the people that have been buying for the last few weeks are gonna choke them up here down to the 318 level. For me, like I said, I'm looking at this as, where's our daily? Okay, so on a daily basis, All right, so this is the long situation, okay? So this is the median line here, roughly 23. So this would be the spot then where one would come in and add. So that would be if you're a UGAS person or that kind of thing, where you're making, you know, you're making here's a higher high, and what you're looking for is a lower low. All right, we do have some weather-related stuff, but that didn't pan out on here. What do we have here? So we had higher prices and less money, so they were selling into the rally here. That would be your swaps. Okay, so we're back to this thing here. Some money came out. So this is basically it for right here, 24. All right, we'll see in a couple hours when the market opens up. See if they how it looks. I just look at it as you know, consolidation type deal here. It's at about 28. Okay, and then that's back into this area. Okay, as a stretch. Now on the flip side, 2 hour. All right, this is, I know, 10 cents. You know, the pullback is shallow. See how it's shallow? You know, you have your up move and pull back and up move and pull back and up move and pull back and up. This is just kind of like a grinding action here. What we need to do is we need to clear 52 here, and then that'll set up going back into the 70s again with the low end of here's 28 and 20. And I would have to say if they do, you know, that would be an area that they start puking it up. And then what I would do is I'd look for going out to forward contracts, because on the longer thing, on a longer look of this, you know, it's still moving higher. What do we have? What's this one? 97. What's here? 28. So that's a dime lower. All right, that's a funky bar there. We need to get you to come up. Yeah, the bodies definitely got into it on a weekly, didn't they? Grrr. A little too excited, weren't you guys? All right, so what's that? 93, 440. All right, so to me, it look, you know, a series of higher highs is how I look at it. Compared to on this way, it was a series of lower lows. 17-year low came off of that in March. So we shall see. But the people were willing to buy. They were adding into this, so they have a vested interest in holding this afloat here. So what do we have here? 4-hour chart. We did hit the lower end here. All right, Sunday night. Let's see about that. Yeah, I sold into it on here. Grr. All right, next chart. All right, so what do we have? Here's the Nikkei futures. Like I said before, if you like trading the Dow, YM, same type of deal here with the Nikkei, $5 a point. Japan has been moving too. Now remember, you know, this is a daily. This is you know, daily reversal bar. It's actually, it's an inside. The deal is you know, number one trading partner with Japan is China. Okay, so you know, it almost begins to smell like World War II again. You know, all of a sudden there begins to be issues. You know, the Nikkei was the same thing. It's moved. I plotted the Nikkei and the Dow together to see which one would get to 40,000 first. And the Nikkei's, you know, they're catching up again. There was a good spread of over 1,000 points at one time. But it was just because they're both price weighted. I just, just something to watch. But the same thing again too is they open up first. Um, uh, uh, um, so I mean, if you want to get, for an open market with the sun shining, you have the Nikkei $5 a point. Same type of deal with the Dow, price weighted. But the deal here is that you get moves, you get hundreds of point moves, not just the Dow will do 150 to 300. You'll get moves of 400 and 500 and 600 points. So the Nikkei it's pretty well clean, technical wise on here, but you can. I mean, it has some pretty good moves here. Lower lows. They tried to make it go for it here and failed. So that's the thing. Asia opens down, then America opens down. The books passed. Different things are traded. Unilever is traded in America. It's traded in Europe. Apple's traded in London. That kind of deal. Frankfurt. So it's you can watch those ahead of time. But I'm on the West Coast time, so. Gosh, right there, median line. What is that? 400 points, 400-point drop. Well, we shall see, won't we? NASDAQ, we already went over. This looks like a series of hot tops that just couldn't handle it. And then they had a really big outside bar, closed under pivot, and that was a support area too. I have to lean that, the NASDAQ is just having too many problems. It just can't get with the program at all. This could be another failed. I mean, they broke out by a few points up in here, and then what did they drop? They dropped 300 points, gave it another go. So it's one of these things that the bulls need to get the show on the road here. Not as much as in the Russell, but on the NASDAQ and that. But you can see it went higher, and just the money just didn't come in there, even though that it's kind of, it's at a new high, just not interesting anybody. And that's a median line. Here's the happy place. There's one up in here. I have 55. Yeah, we'll say 60, 48, 60. But once again, any losses here, I'd have to say that this is going to be dealing with a bull trap. But we'll know once everything opens up. And you have to give it another day because of options expiration. I always like to go out to Tuesday, see how Sunday does, Monday. Monday is a full day, and then you talk about your turnaround Tuesday. But we'll know more once it kicks in. Our world finest Palladium finally got some rollover on there, but you can see how it found support level, and the green is the support level and bounced. Palladium is holding up a lot better than platinum. Found its happy place too. Sorry about all the dots. I thought it took care of that. Found a happy place. May have a bounce from here to 710. That's the only one that's not holding up, so I'm not sure what's going on there. It's a thinner one too, contract wise, and stuff that comes up rarity, than gold. Platinum had a heck of a Friday move on here. Basically, it swiped up above on the highs here early in the month, came down, had the hard sell off, but it reversed on here. And this is a thinner one also. I was looking for a move to go to 1,000. The first time it was only 50 points, $50. Here you have one where, I call them springboards or slingshots or catapults or whatever, where they jab down below underneath, and then they come flying back the other way. So remember, bear markets are short, sharp, and quick. So it's the same. I mean, if gold shoots up $40, $60, $80 in one day kind of thing, 75, I guess. it's not real. I wouldn't lean that it's the start of something. It's just a massive short covering rally. When oil fell from 147 down to 36, it had an up $25 day in its bear market rally. So same type of thing where it could be thin. Friday, was the same thing where they came down, tested it like with gold, and then bounced. Gasoline, there was the run up. They actually didn't come in the second time with the money here on gasoline with the OPEC deal. They didn't. See, this has me to believe that there was a lot of hedging going on with these spikes. That these guys, stronger dollar, it's commodities at price. You're getting that pressure too. Basically, the same thing sideways. If you get a breakout, when you trade sideways, a trend breaks out kind of deal. Sugar, we were bouncing. We got into the 17s on a weekly. I looked at this at a weekly. Okay, so here's a weekly. Okay, so we get a weekly, basically 5-wave up, pull back. Money barely came out, but we swiped underneath this area here. Okay, it's one of these that I have to lean at it. That this is a 50. This is basically a correction of the move up. Okay, so it's one of those that you want to come in and kind of support it down here if it gets that far. We got close. That's how I just have to lean at it that way. Is that this is just a pullback of the whole thing. Okay. What does a monthly look like? Monthly. Okay, so we were higher. Bodies are in there though. Grr. All right, so here's the happy place. Lower 17s here. Okay. Goes along with the soybeans deal in South America. Prices cleared here, went higher, came back. It's like a retest. And then you're going to have to play it on a shorter term basis to wait for it to come back. Yeah, that looks pretty good. Trend line underneath here. The little dots, guys, here. Where am I at? This thing here. That would fall under average trading range, trailing stop. Okay, now what that does is that just moves it underneath. This would be your stop. So like the blue ones here, here, or hold it. This is your average. This is your SAR. Okay. And the blue lines here is your trailing stop, and then your red lines when you're playing the short side of it here. Okay. Yeah, those dots there, you were short, and then this was your trigger that you're out of your short, and then the pullback, and then now you'd be long, and this would be your trailing stop behind it, your SAR. That looks somewhat constructive. Let me trade sideways here. In sugar. Silver, now that looks like a bear flag. Silver was the only one that was actually holding its own up here, but it didn't bounce off the bottom like the other white metal, palladium here, or platinum. It's not clear cut. It's one of those that it's been trading down for a very long time. What do we have going on here, though? 16. That's the other thing, too, is I talked about, like how the Hunts cornered the silver market. Same type of deal, If some rules are going to be changed and some agencies gutted, like the whole offshore stuff, running it through Switzerland, I wouldn't put it past them. Games can be played. You buy up, you buy it on paper, and then you want to take delivery, and it's not there. But for me, I'm looking for longer trends. Um, you know, all through here, nobody wanted silver, nobody wanted silver, nobody wanted silver. That's when I want it. Every day, every paycheck, whatever, I can go out and buy, you know, a 10-ounce bar for $50. 10-ounce bar, 10 ounce, for years, 10-ounce bar, 10-ounce bar, 10-ounce bar. We're off to the races. You know, here's where we're at. What's this? $12. You know, it's that kind of thing. You know, this is, you know, it's pointing down. It's tough to make a bullish case on here unless there's nefarious activity. You know, there's, you know, I try and find some, you know, nice and quiet, sock silver away, and then it takes off. And that's basically what I'm looking for. Here's the Russell. Let's take a look at this on a daily real quick here. That's a choppy pattern. Money, they got excited here. Yeah, be careful on the Russell here. What do we have? Okay, so here's 1250. So money came flying into the Russell, you know, and then that's the whole thing. So when's the Santa Claus rally over with, right? You know, this is where it's at. It got started early, you know, and now the money peaked here. So you're going to need fresh players to move this thing higher. This would be its pause area here, 1300. So it's 60 lower. But like I said, you know, this is the ultimate breakout area here. But we'll know more once these open up. Ultra bonds, the money's flowing out. Where am I at here? I have to go look at a longer term since we're buried into the corner here. All right, so we're down to here. Okay, this is an interesting bar here. Opened here, traded up, closed lower. Okay, so basically kind of what it did is it's lost its momentum lower. What do we have here? So here we have a high at the beginning of the 15. And then we traded lower into the summertime. Okay, so we had interest rates rise into the housing market. Okay, and here we had in 16 lower interest rates into the housing market, second part of the year. What I'm looking for is just, you know, in a perfect world is that these lows begin to hold and then we trade higher into in the summer months. That would probably mean too that equities would come off. This is a pretty good run in anybody's book. It's quite severe. You know, yeah, we're only back into the 2015 levels, but that's a pretty, in anybody's book, that's a hefty drop of something that, you know, we have a lot of debt. And if it continues to fall, that's definitely going to cause some issues. You know, people will be having to use words like hyperinflation and that. You know, I'm sure oil would break out. I mean, you'd have to have other things that would, you know, make the narrative. And in your Dow, here's your reversal pattern type of deal of FOMC. Remember, we talked about it earlier in the week about the call buying, and it worked for the puts. But like I said, it doesn't really. They don't make it that easy, so we're in a sideways range here. So it's either going to, you know, once again, it's either going to break up or break down. You know, one day probably didn't relieve the call buying. You know, they're going to think this thing is bulletproof. This is coming off of the election low. Okay. The Dow can mask stuff, remember, too. So let's take a look at the daily. You know, just the angle of ascent. You know, fat bar, and bar is beginning to thin on here, and we stalled. What I'd like to see, though, is like a poke up, and then it's lost, and then have it come down. But like I said, it loses here. You know, you're going to start making these weekly bars, you know, pretty ugly. You know, if you poke above it and come back down, you're going to have an outside week. People use terms like key reversal, but you can see when you had some hefty moves, you know, pulled back, hefty move sideways. Hefty move. Like I said, with the call buying, at best you could have sideways. At the end of the year. So it's like I said, you need the confirmation, as they say. The momentum is up. You can see that the money flow came in here. But once again, they didn't want anything to do with it on ES. They came in on the Russell. They came into it. This took off about half here. They came flying into the Russell. Which one am I missing? NASDAQ. Same type of deal. It's trying. Which one? Russell. I get them all right. Yeah. TFYM. Yes. Yeah, I got them all. All right. So that's, I'm going to this week, the bulls have to hold it, or I think we might get ourselves a bull trap here. You can see they poked their nose through it and came back. They poked their nose through it, came back. They're trying to get. It's like you can actually just feel it how difficult. I guess you could say 1, 2, 3, 4, 5 here too. But like I said, just because it loses last week's low, it still has to keep clicking through these here. But with the strong dollar, and you're dealing with interest rates, I think that's just going to cause havoc. Here is an interesting pattern here. So here's a 4-hour on bonds. Traded higher, Friday comes through, and it failed to make a lower low. Money came out, though. Okay, so to me, it's kind of like it's running out of the selling pressure. If you go to, let's start with the daily, it all of a sudden it begins to stall down here. And the commitment of traders begins to show that people are, the commercials and that are beginning to buy down here. So this has been a pretty hefty sell-off. It's getting to be pretty obvious with people. Look at, here you had the money come out of it, but it didn't make a lower low, so you spooked them out of it. Okay, so what's this, about 148, 147? So the same numbers as last week. And here also you have a series of lower or higher lows here coming off the bottom, but you can see how the money came out of it, but it didn't make a lower low, so it actually spooked the people out. So basically, the bottom fishers came in, and then they puked after the pullback, but it didn't make a new low. So this is the reverse type of on the upper end. So you're running out of sellers, okay? And that, like in an ideal world, that the bonds trade higher through into the summer. You could have just a large short covering rally, over the summer. It's up to here. We're back to, like I talked about. Here's 150 area, 151. You begin to start working your way up into here. I'm not saying it's going to happen, but what I'm saying is all of a sudden money came out but failed to make a new low, so people got spooked out of their position. And what do we got? So here's the new year here. Okay. Corn. I'm gonna have to move these to daily here because they're a little tough to read. The money is moving into corn. Here's our happy place, the old 357, and we're on it. You have the corn, wheat, and beans. Like I said before, games can be played. All of a sudden you buy up a stockpile and then you hold it from the marketplace, because a lot of these things aren't usually, when you have harvest, you have lows, so we have highs. So that's all of a sudden it's not logical. All right. So to me, what I saw was an awesome year of crops. Okay. We have a stronger dollar, which should pressure this. So here you have both the price of the commodity moving higher and the dollar moving higher, which means that people, if they want food, they're getting pinched on both ends. It's costing them more dollar wise, and it's costing the underlying. You know, I'm looking for some sort of drought. You know, coming up here, it's one of these things that, you know, you broke through, but you couldn't hold it. So, you know, like I said, you know, you can draw your, it's kind of like cotton, you know, just draw your trend line on here. You know, I'd rather, like I said, go after wheat because wheat's been going sideways. I mean, if there's any continuation, you know, beans, I have to believe it's South America related. You know, here you have fives. Okay, so you had the money come out of it, and all of a sudden we get one up move here in a 4 hour, and money flew into it, and then you had a reversal. So this would be, you know, if you're going to be, you know, bullish on fives, going against the trend, Kev. Well, you know, it's one of those deals that this would be a reversal bar, and this is going to be where you want to cover your shorts on here. Okay, if you are short this 116.30, the high of that bar, because you could have another reversal bar. If people want, you know, it's going back to the Will Rogers, the return, not the return on my money, the return of my money. So people, you know, if you're willing to sit out for half a year or something in debt, you know, and just collect a yield, some people would prefer that over, you know, just what we're seeing in the marketplace. And here's bean oil. Let's go back to a daily on here. All right, so here's the same type of deal. You had bean oil move up, but the money didn't come into it. Okay, so I have to, you know, you could see how they both moved together. They moved down, they moved up. And then during harvest, they came out of it. Okay, so I'm not the only one that's going, hold on a second, why is this trading higher? Well, obviously the market's right. It's the humans that's wrong here. On a monthly basis, let's see here. Let's see what it gives me. Bang, we hit, this is your ATR type deal, and we hit the high, opened here at the high, and we reversed. So like I said, you know, with beans and stuff, you know, it's the wrong time of the year. You know, I'm leaning this way. I'd like, you know, on the greed side of me, I'd like to have it come back. You know, it has a nice quiet period before it explodes again for a drought. But we are, you know, 16. See, here's the thing. 2008, 2012, 2016. Well, I did that, you know, 1980, 1984, 1988. And then you're going, okay, 1992. And guess what? It didn't pan out. It didn't hit till 1996. So here, you know, here's another one where you could have where they're caught on here, and you could have just a precipitous decline. You know, this isn't the prettiest bar here on a monthly either. Soybean meal, basically the same thing. You know, we're seeing the run in meat, so you're going to have guys that are going to, you know, expand their lots and, you know, add more cows and add more pigs, so they're going to need more feed. Pigs are easy. It takes about 9 months. Cow, it takes about 1.5 years. So there's just a wee bit of delay. But here you can see where, you know, the meal's not holding up as well, and that's why I kind of, you know, falter with the corn. Oh no. Where am I at? Come on, Kev. So here's bean meal, you know, so, you know, it's doesn't look too bullish. I mean, it had a good run, but now we're in the lower part, and it's not really seem to be holding it together. So, you know, now we're getting up to, what's this one here? Notes. Okay, so here's notes. You're beginning to see money move into notes as prices are kind of stalling out here. You know, here was the low, but we didn't, no carryover here. Okay, no continuation. So your reversal bar 123 should set up a hard short covering rally. Where am I at? Alert. 123.03, we'll take it. Okay, so that would be your reversal bar for a hard short covering rally. That's how, because of that's this, the FOMC came in. Um, I didn't see the swing then, and then we traded lower, and then, you know, like I said, just because it did it, it needs to have follow through. And it's not that I'm looking to take it, you know, take them to the shed this way. I'm looking for places for folks to get on the short side of things if they missed it. Here's the soybeans banged up against the moving or the average trading range. You know, this is your short, and we're tagged. This would be your long stop, and it was tagged. You know, short side, it was tagged. See, amazing how the computers tag it, causes somebody to have to get out, and then they work the magic the other way. But you can see bodies getting out of it. Why am I January? I need to go out. X17. Okay, so here's our 4 hour. We were looking at it daily before, how it hit a high of 1040, poked its head through here again, and it's not holding it here. They gave it another shot with the unbalanced volume, but to me, it's beginning to look like a head and shoulders type of deal, except for not really. Now we get the little triangle action going on here. They're making a run for it. See money coming back in, but we closed. It's not holding up here. So I think, and then I think it's on the weekly, you can see all the bodies in there. Where am I at? Where am I at? Oh, looks goofy. How about weekly? Here's weekly. Yeah. Okay. See, remember, so here was the high before. Here was, okay, this also works with the stock market. This is a weekly. So you have a strong up week, and then you actually have an outside reversal on a weekly. I follow weekly bars, keeps you in the longest, you know, and you can see that it continued. Just, this is a weekly reversal. Came back down, went flying back up here again, and a lot of bodies, barely poked its nose through on the upper end. I'd have to say that this thing is just going to collapse. That's how I'm looking at it. Excuse me, should have hit the mute switch. But you know, you kind of got that triangle thing going on here. So, but like if you're producer, hedge kind of deal. Because you could have one of those, like I said, where we saw where it, you know, every 4 years you get the drought, 4 years, and then 92 didn't happen. It happened in 96. So you could have that, you know, there are times when, you know, cycles work 14 out of 15 years, you know, that kind of thing. So. And 2, same thing, money rolled in on here. So you may have one where they get out of equities and they run into debt. I showed you that on Thursday, I believe. And then wheat, money is moving into wheat. We're getting sideways action on here. Of course, it needs a, you know, just draw your trend line in underneath here. It came down and touched the median line. You know, like I said, the pros that are short, they're going to whack this thing whenever they're still on the sell the rally mentality here. But you see money moving into wheat here. Okay. Basically, you know, we basically have a sideways. So something's going to happen here when it breaks out, either trade higher or lower. Remember the deferred contracts, because you saw the price of beans, right? So what's going to happen, farmer mentality, planting wise, they'll probably rotate into beans, right? Because they can get a pretty high, you know, compared to wheat down here, that kind of thing. Whatever rotation they're on, that kind of thing. That's the other one too, is just because they planted it doesn't mean it's in the bin. Then you have it reverse the other way. If there's something wrong with the crop, you have a lot of it. That's not gonna come to fruition. You know, the fruits of the labor there. But the money moving in here quietly. Commitment of traders shows them short. The big guy traders short. So things are beginning to narrow. So it's one of those where are we at here? 405. You know, wherever your stop is, it needs to it needs some follow through to both sides. But like I said, we're getting sideways action here, so at some point it's going to break out. It's probably 18. It did sneak its little nose up here. It fell short a little bit. It doesn't mean that it can't trade sideways for a while here too. So, but it's you know, it's one of those where on a longer term, say 3 years, you know, it's been trading down for a long time, and then it stopped, paused, you know. So watching the wheat here to see if we get some sort of breakout, and you can go, you know, watch your distant contracts. And back to E. So I guess that's that. We're back to that. All right. I'll leave you with this. I'll go into equities. Bye-bye.